Hi, everyone. I'm Rick Bensignor, and welcome to this week's In and Out Trader Show. We come into today with U.S. equity markets pushing on 2019 highs. In fact, when we look at the S&P, we see that it's kind of on its last resistance area before last fall's all-time highs up at 2941. This major benchmark index has recouped 99% of its decline from that same peak. And yet I still see a slew of technical analysts saying that we're in a bear market bounce. So today, there's a couple things I want to go over in our half hour together. One is going to be on what I call the primacy of discipline. So we're going to talk about how important discipline is and how to incorporate it into trading. And the other part of the show, we'll look at a bunch of important markets that I think many are improperly positioned in. So that's often a very good opportunity to make money because you've got too many people leaning the wrong way who haven't yet gotten out. So let's start out with the idea of the primacy of discipline and my belief that it's highly uncommon to see somebody approach the markets with a vastly different come from that they approach their lives in. If you're a risk taker in general in life, you tend to be a risk trader or a risk taker in the markets. So think of it in these terms. Part of the success of best traders is having the ability to get out when they say that they're going to get out. And then when a trade isn't working, they simply walk away from it. They don't typically hem and haw. They don't start praying. They don't go to church or synagogue and start asking for help to bring their trade back to a profitable state or even a break-even state. They just simply, the best traders simply just get out. And that's a discipline that over time you prove to yourself that you can stick to essentially what you've set out to do in the beginning. Because when you think about this, lots of trades you come from the mindset of committing capital in something that you intend to be a short-term trade. So it's not something that you come in and you say, I'm going to be holding this 8 months from now, 1 year from now, 2 years from now. This is not an investment. This is a trade. This is taking advantage of some type of anomaly in the market that something's mispriced, and you think that in the next few weeks or a couple months, it'll correct itself back to where it should be, and therefore that's the reason, let's say, you're doing the transaction in the market. So let's say, think of it in terms of, well, I'm buying it here at level A so I can sell it out here higher at level B. But I have no idea long-term if this is going to be a good buy or not. But there's money to be made here. So I put on a trade. And the intention is that this is, in fact, a trade. And here's where the discipline and the, almost I'll say the maturity of a trader comes into play. If I intend something to be a trade, and the trade starts going against me, but it's still within the parameters that I set out when I first got in, I'm still okay. So think of it this way. If you buy a stock at $50 because you think it can get to 58 in the next several weeks, months, but nothing more than kind of the shorter term time frame. If you pay 50 and it goes to 48, that might very well be within the context of what you say is fine. I know I'm not going to get the exact low, so a few percent against me I can live with. But let's say if you say, this really shouldn't get down to 45. And if it does, I'm probably wrong. So if the trade starts going against you, and as I say, you paid 50, it goes to 48, you go, all right, I'm a little early here, but I think I've got the right thing on. That's fine. If it gets to a level beneath where you got in that was not in the realm of what you thought would occur from the time you got in and the analysis you did, and I'm not saying that it's a fixed percent. It's a level that you didn't expect to see, given the time frame that you're looking for this to do. My suggestion is that you get out. But that's not what most people do. They'll look at it and they'll say, okay, I was too early. I'm now down $5 on a $50 long. Let's just hold this. I'm pretty sure it'll come back. Well, sometimes it comes back and sometimes it doesn't. And bull markets over time, which is, of course, what we have in the marketplace, often saves a lot of people's rear ends because ultimately, if they just hang on long enough, the market will come back. But that's not a successful way to put on a trade. And even if you made money ultimately on it, I will tell you that the likelihood is that your psyche took a hit and your confidence took a hit because it was the bull market that saved you, not your analysis. And you didn't stay disciplined. You didn't stick to what your original intent was. And that actually ends up being costly. So take an example of something like a stock like GE, which a couple of years ago was trading up at 30. And let's say you had done your analysis at the time and you're long GE at 30. And, if it got to 28, you're okay. But if it got to 27 or 26, that was not the intent. If you had gotten out then, yes, you would have lost $3 or $4. And as a percent on a $30 stock, it's a hit, no doubt. But now GE trades at $9 or $10. And we have no idea, the entire marketplace has no idea if this stock is going to come back to $20, $30, or anything more over time. We simply don't know. Now, you could tie up your money for years and hope and pray that this comes back. But to me, you're much better off if you had just simply gotten out at the time that you realized the stock wasn't doing what you thought it was supposed to do. And that's where the skill comes in, and the discipline comes in, and the ability to admit to oneself that they were wrong, and then not only admit it, but act on it. And that's the hardest thing that most people have to deal with when we think of trading psychology. We think of the fact that most people have a really hard time of admitting they're wrong and then taking small losses. So generally, I think of things in terms of, if you're a risk taker in life in general, you tend to come to the markets as a risk taker. And you tend to take on riskier bets than people who are rather conservative, who then would generally play the markets in a rather conservative way. Often it is said that how you approach the markets is an exact mirror of how you approach life. Riskier people willing to take risk in life, generally take more risks in the market. It would be uncommon to see somebody who's pretty darn conservative in the way they lead their lives and start playing commodity futures contracts when they come into the market. That's a mismatch of, I'll say, personality. You don't usually see that happen. You tend to be in the markets as you are in life. So the more you take losses and show yourself that you have discipline and that you're really readily willing to take losses, the more success you're going to have over time, because you'll tend to trust yourself. And the way you trust yourself is by doing what you say you're going to do. So if you get into a stock at 50 and you say, I'm willing to be with it, but if this thing gets down to, pick a number, 46, whatever it is, that's not what I expect. That's not within the realm of what I'm willing to risk in order to make, let's say, $8 on the upside. I don't want to risk $4 on the downside. Whatever that number or ratio relationship is, you should know before you get into the trade. And if it doesn't work, it's just simply a trade that didn't work. You get out, you take your small loss. The sticking with a bad situation ends up typically leading to much bigger losses. And the thing is, your gut usually knows fairly soon when you've got a bad trade on. There's this intuitive part of you that senses this is just not working. And the suggestion on that part is when your gut tells you that, it's usually the right thing. And if you listen to your gut, you get out of this trade, you take a small loss, and you move on to the next idea. So the idea of having discipline actually ends up being a tremendous ingredient to your success. And you're rarely going to find any trader on Wall Street who's made good money who doesn't have discipline. The best traders will tell you that their success largely came from being able to take lots of small losses. And if you think about it, that goes against what most people are programmed and how most people are programmed to think in life. We want to believe we're right, and we don't like being wrong. And yet trading is a game that you need to recognize that you will frequently be wrong, with the intent that if you keep your losses small and stick with the winners that are working and are now trending in the direction you expected to trend, you can ride your winners for well beyond what you lose, even if you take a bunch of small losses, right? If you can keep your losses small, who cares if you take 4, 5, 6 losses in a row, because that next winner that you really capture the trend correct and you stay with is going to make it all back in a trade. So just, kind of today's trading psychology tip of the day is stay disciplined when you trade. Understand that your gut usually knows far earlier than you act that the trade is not going to work. And if you listen to your gut, you're going to have and act on it, you're going to have a much better chance of making money over time. So that's my thoughts on that. I want to take a look at some charts now that I think a fair amount of people are incorrectly positioned in, at least enough so that there's been opportunity along the way. We're going to start here with the S&P. And we've got a basic candle chart here with a couple of other things to it. Let's talk about what we see. First off, this dashed deep maroon line is simply the trend line that had been in place from the early 2016 bottom, which at the time, remember, the January, February sell-off in 2016 was a significant decline at the time. Obviously, the market's done vastly better since then. And where my arrow is now, and here sometimes it's just easier to look at. So here's the all-time highs from last October. Here's the Christmas bottom over here. And then, of course, the massive move back since. And you can see that the S&P is bucking up against that same trend line. This is now the fourth week in a row that we've bumped up to it, but because it's an ascending line, we keep moving higher. So we can't say we've pushed through it yet, but certainly price keeps going higher. If I add on a model here, and we'll blow this up a bit so you can really see. The blue or teal colored triangles here are really just a line, and I set them up as triangles to make them easier for me to spot versus other lines I put up here. This is one of the Tom DeMark models that's called Propulsion, and it has a value of pretty much 29.12. Now, as I speak, the S&P is at 29.19, so we've pushed a little through it. But when I look at the combination of bucking up against this old trend line in maroon and the fact that 29.12 is a propulsion target, it tells me I probably don't want to buy right here and now, and that I'd be willing to wait for kind of a push through here and possibly even through the all-time highs to then to do additional buying. Now, of course, if you've listened to our podcast for the last 2 months, 3 months, you know that we've been bullish for virtually the entire move up after the Christmas low. These darker kind of green arrows here were the propulsion buy signal. Again, this is a model developed by Tom DeMark. This is based upon physics in the market, and it suggested that if we broke through this level, which was, let's just say, roughly 26.30, it would project that there should be enough force to take the market as high as 29.12. And that's, today and last week, this is where we're up against. So it has nothing to do with much of what occurred in the past. It has a lot to do with how it bottomed and again, the force behind the bottom. And it measures up to this 29.12 level. So yeah, we're 6 S&P points through it. That's about 0.25%, not enough for me to really say we've broken through yet. If we take out all-time highs, the next target would be just about 3,000. That's from a different model that measures market increments in 5.56% moves, and it would say that that would be the target. So I don't think we stall against the 29.41 all-time high. I think a lot of people have still missed this move. Again, as I started out the show, I can't believe how many people are still bears in this market simply because of a 1-week decline in December that broke beneath here. So if we highlight, and we'll make this a different color just to make it easy. So if we look at the orange horizontal line, that was the February low. That was last year's low for all year until we broke in December. So you get this 1-week break where we close beneath it. The next week, we close above the prior week's close. And then every week, we keep going higher. And you look at how many strong candles you have here, too, where you close near the highs of the week, is almost week after week until you get into early March, where you actually close that Friday closer to the bottom of the week. The fact that we had this 1-week breakdown and got so many people bearish and then fighting this whole move up all the way kind of amazes me. That still here, up north of 28.50, I still hear people talking about this is just a bear market bounce. Well, this is one heck of a dead cat bounce for something that was never a dead cat, because we've now recouped 99% of the decline, right? We're 1%, or at this point, even probably less than 1% away from all-time highs. I simply don't see how people continue to call this a bear market, but nonetheless they do. And it's given us the ability to exploit this for quite some time now, as we've been long and guiding clients to play the bullish side of the market. So the S&P definitely has people on the wrong side. You still see benchmark chasing and the fact that portfolio managers need to come in and buy up now and rotate back towards cyclicals as compared to the defensive sectors that they were correctly in for part of last fall. And yeah, we had this massive 3-week decline starting in essentially December. So they were correct. But so many of them stayed defensive into the beginning part of the year and are only slowly unwinding and getting back into cyclicals that it is, you'd be hard pressed to find a mutual fund manager who's benchmarked against the S&P, who beat the S&P at the end of the first quarter, or is even ahead of the S&P at this point this year. It's just very few and far between. So in S&P terms, again, I don't want to be a buyer right here, right now. I don't mind giving up a little extra to get back in, but the next target up would be 3,000 and above there. You've got targets at about 3060 and then about 3130 or so. On the downside, if the S&P pulled back into this area right here, where you see this purple line at 2772, something like that, anything around there, I'd be a very willing buyer. So if we got a pullback that so many bears are looking for, that's where, as of right now, I'd be looking to put on significant longs, just in and around 2775. Okay, let's take a look at the 10-year. So this is TNX, the US 10-year index, which obviously replicates Treasury Yields, the 10-year Treasury Yields, just with the decimal moved over. So at the current price of 25.69, you can interpret that as being 2.569%. So what happened here is that we actually had a false breakdown that got lots of people long the market, long meaning bonds, looking for yields to move significantly lower, especially since our Fed chairman flip-flopped earlier this year and took interest rate increases off the table and said the Fed would be neutral, and a lot of people thinking the next move they do is a cut in rates. The cloud chart itself, which is one of my favorite models, also had a breakdown as this bold blue line broke underneath the bottom of the cloud here. And yet we had suggested that rates were only going to get to 23.44 or 2.344%. We got 1 basis point away on the low of the move. We got to 2.356. And the fact that we bounced right off of that level, and that level comes from, that's this dotted red line that, again, comes from a Tom DeMark model that suggested that there was support here. Most people would not have spotted that as a support level. The next level down they would have had was down at 228 or so, where 50% retracement was from the whole big up move from the cyclical, or actually the secular bottom back a few years ago. And now we've just barely broken above the downtrend line from last year's highs at 3.25%. So bond yields right here, right now, kind of in this mid 2.5 range, is at a critical level. Because if we get any more steam to the upside here in rate terms, we go to the high 2.7s to the low 2.8s as the next target. And I do believe a fair amount of portfolio managers have become very bullish on bonds, and yet the 2.34 level, 2.34 level is really what held. And we're back 20 basis points higher, and you've got, I think, a fair amount on the wrong side. So if this continues to move higher, and I even suspect that if we take out last week's high of 2.61%, that we are going to see another probably 20 basis points to the upside until you see the next level of resistance. If you look at the bottom of the chart too, the MACD is very close to getting a buy signal. Slow stochastics have already double bottomed and bounced and are showing bullish mode. So I think I've got enough here to at least certainly not want to be long bonds from a trading perspective, and possibly be short them just because so many are on the wrong side. Let's move on to gold. We've got a few minutes left, so we hopefully finish up the last couple charts. Here's the big picture of gold, and we know there's just a wall of resistance going back for 4 or 5 years now. You can see all these maroon colored horizontal lines that are anywhere from about 1345 to, I don't know, 1380, 1385 or so. All the major tops took place in there. We recently just got up to 1344, and we've pulled back. So I do ultimately think gold does break through these, but the question is how to figure out the timing of where to get in. We've been telling clients that from an investment point of view, for a longer term point of view, if you believe that 2015 low at 1,040 or so was the good secular low coming off of all-time highs at 1920, which we do, all right? So all-time highs are all the way back here in 2011. So we do believe that this low is the secular low for gold, and that last summer's low is probably the cyclical low. Then somewhere in here, and it's, look, you're just flat in the, you're in the middle part of the trading range that's been in place for years now. And somewhere on this pullback, you want to be a buyer if you're looking to invest in gold, and think that 1,400 plus can come in the next few years, which I do think. So being that this week is currently a 9 count down, and again, in a DeMark sequential model, this means 9 consecutive Fridays that the close is less than the close from 4 Fridays back. They're often turning points in the market. You had a 9 count here as a bottom. You had a 9 count here as a bottom. I can show this one did not. Here you are again. Anywhere from close to where the market is down another, let's say $30 or so, is the place I would probably come in if I'm looking to kind of position, looking at a longer term uptrend against horizontal lines. In other words, an ascending triangle, this long-term whole rounded bottom would say that you want to buy on dip. So I am a willing buyer in gold from here all the way down again another, let's just say $30, give or take, even $40, anywhere down to even $12.20 to position, right? So you don't want to be in futures in this. This is something that you want to, buy GLD or something that's a proxy for gold without having to worry about margin or what you get when trading futures contracts. So look, we looked at a bunch of markets that people, there's possible a chance here to exploit misposition. And I think that's it for this week. So thanks all for tuning in. And this is Rick Bensignor for In the Know Trader. The last thing I want to show you is here's how to contact me, Rick at In the Know Trader, and inthenowtrader.com. Thanks much. Have a good week.
This video will show you how to add a date line to your charts. So if you have a whole bunch of stuff piled up here and you want a date line farther down, there is a way to put it on there and how to move it. So down here under indicators, it's one of the options, date time axis, and by just moving it up and down with these triangle arrows, and notice this little blue arrow that moves with it, it'll help you position it exactly where you want it.